8/21, 2012, S&P 500, we finally hit our target MMTs. 4.5 year highs on the S&P 500 in the month of August. Back here, we gave it very careful thought that the monthly moving averages were rising when we had these pullbacks. And then we got that big summer rally that we started June 4th. And with the wall of austerity, I call it financial hardships around the world, the economy, all of it doesn't matter. This particular rally, and I've been in many bull rallies or bull runs, is that most people hate it. We love it. And the reason why the people hate it is because they're not in it. However, listen, the more pessimistic that we get, the more broader that the bigger community is negative, we continue to climb that wall of worry higher and higher. This was where the 2008 and the financial crisis started. We were very aggressive short sellers. Look at that S&P has come straight back up on this monthly chart. Now, back in June, it was a perfect time to get net long the indexes because at that particular time, when we were down here, the put to call ratio had given me a big buy signal. Okay? And what that meant was that the call was the call side of the market was very deflated. And there are different put to call ratio readings that will tell you when it's good to get net long. Well, that has played its course to these monthly resistance levels. 4.5 year highs. We're testing this monthly half bar right here. We're going to tell you that it's been a lot of years since we started the actual bear. That's where the bear started in 2000. We've been in a bear for over 12 years. And how would a bear be broke, or a bear economy and a bear market be broke after 12 years, almost 13 years? We were over here, okay, and we made bottoms and we rallied up huge. And we remember it right up to the tops. That was that 4.5 year expansion, Iraq war, you name it. That was under the Bush administration at the time. This particular bottom here came all the way back down to test the 1996 breakouts. And then we've come all the way back up over these years. 2009, every dip was buyable, every short, every dip. Hedge fund managers have underperformed the broader markets this year. People are going to chase performance if we get a better economy and we get a lower tax rate. Canada lowered their tax rate today to 15%. The U.S. has to compete. We have to do the right things in order to break this bear economy, and it's going to have to come from fiscal policy, and we're going to need a new president. And we've always said what it would look like to break this long-term bear that started over here in the tech bubble of the year 2000s. We've been around all of these years. We got great rallies off the bottom, buying the dips. And when everybody wants to be in the market, that's when you want to talk about taking profits and getting short. But when everyone hates the market, they don't want to be involved in the market, that's the time to get net long. And it's proven its course, and it's ran it. And I will tell you right now that we already had price targets on the S&P in our other analysis. We got 1426. We got 1438, 1445, all the way up to 1460 that this S&P could continue to climb. We have major news coming out around the world. It is in the dog days of August. The more pessimistic they are, we continue to climb higher and higher and higher. And the thing that we love about these kinds of techniques, even though most of it's done in a high-frequency trading model these days, is that people have to chase the market now. And that's how we can get up to these major resistance levels on the S&P. And there's going to have to be a lot of great news that happens because I can tell you right here and now, when we break through there, people will chase the performance. And we can break to multi-year highs all the way back over here where the downtrend started, right here, 2008. And I will just caution people that we need to come down a little bit in the S&P and set up some bases to break this long-term bear. We have been in it for a number of years. It started in 2000. We are in 2012. That's 12 years, 12 and 3/4 years, going on 13 years of this bear with many bull rallies within the overall long-term bear, multi-year bear, calendar yearly bear is about to be broke. Once we break that and we get the right economy and the right ingredients, these markets continue to go higher in 2013, providing that we get the right president, we get the right tax rate, and we get America working back. It's a great place for investors and short-term traders. It's a great time to get into this market now at 4.5-year multi-year highs at resistance, calendar 2012. And you know what? We're very, very excited that if we get a new president, we get the tax rate down, we do the things to stimulate the economy, we get that workforce moving in the right direction, and we get people on Capitol Hill to get off their rear ends and do the right thing, we could leave this bear economy. Worldwide, they're printing money. They're going to be putting so much money in the system. Try to get Europe stabilized. Once Europe stabilizes, S&P 500 is the best place to be because they're making earnings still here in the U.S. But those other earnings that had the shortfall in the downside guidances because of the slower period in the broader European zone, when that comes back online, we could go into a new bull. But let us not forget the realities of what has to take place for a new bull economy versus a bear economy. And if we get the right recipe to prosperity and entrepreneurship can return, and corporate can continue to deliver profits, we have a lot of potential moving forward.